How does depreciation work in real estate? We'll go over this very important topic for investors in this video by doing an example with Hauseit's rental property calculator, which can be found on hauseit.com. And we'll pretend that the target property is an investment condo in a high floor building in Biscayne Beach, which is a high rise right on the water in the booming neighborhood of Edgewater in Miami, Florida. So depreciation is very interesting because it is a non-cash expense that real estate investors can take. So the IRS allows property investors to fully depreciate a property over 27 and a half years. That's for residential property. So that equates to roughly 3.64% of the property's cost basis per year. Keep in mind that this is technically a paper loss, so it can really help offset any rental income you have, and in some cases where the cap rates are and yields are low enough, you may actually be able to generate a loss from the rental property. Now, of course, please speak to your accountant. There's a lot of literature out there about what qualifies you as a qualified real estate professional. If you do get that designation, then you are able to take a loss generated from a rental property and offset it against your other active income. For example, your income doing other things. So that can be very powerful. Of course, that is hard to qualify for unless you are a bona fide real estate professional. And if you're not qualified, then it's treated as passive income and can only be offset against other passive income. So this is important to take note. Please speak with your accountant. This is not accounting or financial advice, of course, but let's go through this example to see how much you can how important depreciation is to an investor. And let's assume you're using financing in this example, which this rental property calculator is very good at for determining your cash on cash returns. Let's assume the purchase price is $940,000. Cost of renovation, let's say it's in great condition, there's no renovations needed, it's actually furnished, so it's move-in ready and ready to rent out immediately. Let's say per recent comps you've seen in the building for this direct ocean view or direct bay and ocean view high floor 2-bed 3-bath unit, you've seen some comps for $6,500. This should probably rent for $7,000 just because the market has improved and it's in great condition, has upgraded doors and other furniture, and has nice furniture. So let's say it's $7,000 per month. Let's say that you're able to get a 80% loan to value mortgage on this at 2.5%. And of course, it's a 360 month or 30-year typical loan term. Property taxes are almost $12,000 per year for this. Common charges per year add up to almost $14,000. Let's say you were able to get a quote for interior condo insurance for about $1,000 per year. Let's assume there's, for now, no maintenance and repairs. It's in great condition. Miami is such a hot market with so low inventory that you can assume a 0% vacancy rate. You may have a higher vacancy depending on the market, but Miami and New York City real estate at the moment is extremely hot with almost no inventory. And let's assume that you manage the property yourself, so there's no external management fee. Let's use Hauseit's Miami buyer closing cost calculator to determine the amount of closing costs. If you'd like, in this case, since we already included home insurance premiums for the first year, they do ask you to escrow up front if you're getting a mortgage especially, so it's up to you, but you can delete this from this figure. So let's say it's $12,276. There you go. So the cost basis is updated. So what you're seeing here in the returns, for example, monthly cash flow and annual cash flow, this is just a purely cash metric. It's not an accounting or tax sort of metric. So what this is basically telling you is your annual income. So 7,000 times 12 is 84,000. Less your operating expenses of property taxes, condo common charges, insurance, and then also less your principal and interest payments. So 12 times 2,971. Keep in mind, this also includes principal, so the loan principal that you're paying down. So this is purely just a cash flow metric, and it's saying that after all of these expenses, you're getting this monthly cash flow and this annual cash flow. And then your upfront investment is basically your 20%. You're using essentially 20% down payment. So 20% down plus your closing costs. That's your upfront cash investment. And then basically your cash flow on your upfront cash investment is 10.8%. Again, this is not an accounting term or sort of anything to do with taxes. This is just purely a cash on cash return. So how does this relate to depreciation? Well, keep in mind that depreciation is a non-cash expense, which essentially it's a deduction against your income from the property. So it's a tax metric. It's something that helps reduce your taxable income from this investment. So to do that, you see this cap rate here, which we've discussed previously, as essentially just the net operating income over your initial cost basis. So let's check out Hauseit's cap rate calculator and look at net operating income, which is important here. So net operating income for this example is $57,277. That's per year. This is calculated from total revenue minus total operating expenses, such as these that we've listed here. This would then presumably be your taxable income, assuming you are not using financing. If you are using financing, then your mortgage interest would be an additional expense that would be deducted from here to calculate your taxable income. So let's use just a basic Excel spreadsheet to figure out the taxable income. So net operating income, as we've discovered after expenses, $57,277. Mortgage interest expense, $18,800. This is simply done by multiplying the mortgage loan amount by the interest rate, so 2.5%. This does not account for principal paid down. Only the interest is deductible. Depreciation, this is the cost basis. So again, this is the purchase price plus closing costs times approximately 3.6% of this cost basis. So that's 1 over 27.5 years is about this amount. Now, you have heard before that you are supposed to depreciate only the value of the building, as land is technically not depreciable because it's an infinite life asset. Now, with that said, what we've heard from many accountants is, for practical purposes, for condos, because there's sometimes even hundreds of units in a condo building, the value of the land attributable to an individual condo unit is negligible. So most accountants, or all accountants we've spoken with rather, have said that you should technically just depreciate 1 over 27.5 and give full credit for the depreciation. So anyway, speak with your accountant. Again, this is not accounting advice, but assuming you decide to do that, that's the depreciation expense. And then your taxable income is your NOI minus your interest expense and then minus depreciation. So as you can see, your taxable income has been dramatically reduced. The other point to make is, in this example, due to the high rents in Miami and the low inventory here, the NOI is actually quite high, so we still have a positive taxable income despite all of these deductions. But as you can imagine, in a market with lower cap rates, say Manhattan, where the cap rate might be 2 or 3%, well, you could easily have a negative taxable income. So anyway, we hope you found this video helpful. If you did, please hit like or subscribe. Thank you very much.